Welcome. Today we're covering portfolio rebalancing, why, when, and how to rebalance. Let's get started. Rebalancing is the act of realigning your portfolio back to its target asset allocation. If your target is 70% stocks and 30% bonds, a strong stock market year might push you to 85% stocks. You're now taking significantly more risk than planned. Rebalancing sells some stocks and buys bonds too. Restore your original balance and intended risk level. Here's the counterintuitive upside of rebalancing. It systematically enforces buy low, sell high behavior. You're selling what has risen and buying what has fallen. This is the right thing to do in investing, but it's emotionally hard because we're drawn to winners. Rebalancing removes emotion from the process and executes this discipline automatically. There are two main triggers for rebalancing. Calendar rebalancing, say, every January and July, keeps things simple and predictable. Threshold rebalancing triggers a rebalance whenever an asset class drifts more than 5 percentage points from its target. Both approaches work. The key is having a rule and following it instead of acting on emotion. The mechanics of rebalancing are straightforward. In tax-deferred accounts like a 401k or IRA, you can sell and buy freely without triggering taxes. In taxable accounts, minimize selling to avoid capital gains taxes. Instead, direct new contributions and reinvested dividends toward whatever is underweight. This achieves the same result with less tax impact. Over-rebalancing is a real risk. Frequent rebalancing in a taxable account generates taxable events, and the tax cost can easily outweigh the benefit of staying precisely on target. Rebalance annually or when significant drift occurs, and always start with your tax-advantaged accounts. Precision matters far less than consistency.